Hey, good morning, everyone. Marty Missouri here, Monday, November 18th, 2019. Going to try to do just a quick video for you this morning. You're looking at the 1-minute chart for the S&P 500. We closed at an all-time high this last Friday. Selling off a little bit here this morning. S&P's down, looks like about 5 points off of its high. It was down a bit more than that here just a few minutes ago, trying to stage a comeback as I talk at you this morning. What's it all about? Well, of course, it's about trade news. Right in here, Larry Kudlow said very constructive things on China and trade. Over the weekend, the Chinese chief negotiator said they had constructive talks on Saturday. And then this morning, news out of China is doubtful. Pessimism over the prospects for U.S.-China trade deal. And so stocks are selling off just a bit this morning, folks. I would put no weight on any of the trading right here. In fact, the technicals would be really tough to trade right here. So I wouldn't try if I were you. Better on the daily chart, zooming out a bit, we still have, of course, we still have our upward sloping wedge very much intact. Zoom in a little bit here. Certainly a longer term, wedge pattern for sure. It's going to take a while before we break out of that and have something that looks more bullish. The divergences are still intact on the MACD. When I zoom out here, I'll show you. Not so much on the RSI on a daily chart. One thing that some technicians would no doubt tell you about the RSI, though, is that it's right now in overbought territory, just like it was at all of the recent peaks. You can see it there, you can see it there, right? You can see it, and you can see it here now as we mount further into all-time high territory. In terms of divergence, again, I think we can say it's not there right now, at least not so much on the RSI. Certainly intact, very much so on virtually all time frames for the MACD and most time frames still for the RSI. I'll tell you, I bring this up. A lot of traders put a lot of weight on that, particularly short-term traders on the short-term charts. I really don't. I'm really looking for trends, slopes, divergences, and so forth. Just like this sell signal we got right there. Some are just no doubt waiting for that crossover, which again is a legitimate sell signal. That's actually how this thing was more or less built to show. And you can see we had our sell signal there before this rolled over. Sell signal right there before it rolled over. You'll see that everywhere. And right now we're tempting, right? The market continues to trade lower. It looks like it's fighting higher as I speak. You get that sell signal. That could, I don't know, that could bring some traders in to give it a go to the downside. I wish them all good luck. It seems like anytime we get any semblance of a healthy downturn and commentary that traders are still willing to buy shows up in the media and the market gets bought. Also keep in mind, we're getting to the end of the year. Mutual funds, by and large, from what I understand, have really underperformed the market all year. A lot of hedge funds, had been betting on the fundamentals, and that hasn't worked out. The market has gone up without them, and therefore, maybe there's some catch-up that needs to happen right now. If I were worried about what might occur between now and the end of the year on a relative performance basis, and that were important to me, which, by the way, it's not, but if it were on a short-term basis, I don't think I'd have too much trouble buying the dips. It just happened just right here as I speak. We were several points lower, and now we're back up to about 31.17. A little bit further, and we'll be positive on the day. Folks, that is just money coming in and buying the dips. Let's take a look at what I posted last night on the blog. Why to own stocks right here and why not to. List of reasons why it's smart to own stocks right this minute. Good time of year to own stocks. The breakout to new all-time highs will likely draw in more buyers and see more bears capitulate. The world's 4 largest central banks are currently flooding the markets with liquidity. Add that to, make that the number 2 reason folks would buy stocks right here. This would be number 1. The administration is obsessed with keeping the stock market buoyed. The president tweets on and takes credit for the latest rally. Even the slightest pullbacks are quickly followed by optimistic tweets and or commentary on trade talks. Folks, that is it for the moment. High probability that there will be a Brexit deal announced soon. The pound is higher this morning on polls that the Conservative Party is doing well. with regard to the upcoming December 12th election. Why would it be dumb? Our fear and greed index currently scores 100, highest greed. Sentiments among individual investors, when I look at the bull-bear spread, it is widened notably right at those levels where we tend to top in the market. We tend to get decent sell-offs. The MACD and RSI on most time frames show negative divergences. Market breadth, all-time highs and lows among individual stocks versus the broader average. We are seeing quite the divergence between what's happening under the surface and what's happening in the broader averages, and they conflict with each other markedly. Volume has been markedly weak of late. I showed you that the other day. Certainly the case again this morning, meaning there's no or certainly little big money passion underlying the current level of stocks. List of reasons why it's smart to own stocks on a one-year time horizon. Sure, I mean, it's safe to say, that a trade deal will either get done between now and election time, or the hope of one will be kept alive the whole time. Very high probability, in my view, that there'll be a Brexit deal. That's bullish for global stocks. Low probability that the Fed will upset the apple cart. They are as obsessed with the market as the administration is, it seems to me. Foreign equities, we're actually seeing, when I do my analyses, I'm seeing strength in the Eurozone in particular, also to some degree in emerging markets. Also, Eurozone economic data, it's not great. Make no mistakes, it's still notably soft, but it's beginning to exhibit some signs of green shoots. Who knows? Maybe the global economy may not be on the verge of rolling over, as other indicators suggest. Longer term moving averages, the 200-day moving average, my weekly moving averages, when I line them up, they're still solidly bullish. In fact, they were a little questionable here earlier in the year, but now they're back to being solidly bullish. So, if you just look at those top 5 bullet points, heck yes, market's still in good shape. Smart to own stocks, maybe, if you have a one-year time horizon. So what would be a list of, let's just call it dumb reasons to own stocks, for lack of a better term? No question, the market is pricing in, if it hasn't already done it completely, a trade deal. Man, what will happen if we don't get one? Stock prices have strayed above what current earnings projections justify. Forward price to earnings ratio is getting to be in somewhat scary territory. So we've got valuations that really do not or are not justified by the underlying fundamentals in stocks. Stock prices have been buoyed largely by corporate share buybacks and the prospects for more of that going forward. Companies have spent more money on share buybacks than they've had money to spend, resulted in record level of corporate debt to GDP. I've been spending a lot of time on that lately on the blog. How long can this boom last in share buybacks? Outstanding investment grade debt in the lowest rating, BBB, is near an all-time high. BBB issuance this year, just the issuance, is at or near an all-time high. The Fed says, I shared that with you over the weekend, the riskiest firms account for most of the increase in debt in recent years. Pensions, hedge funds, other yield-hungry investors are pouring money as I speak into low-quality bonds. Folks, that's kind of scary. A huge market-crushing exodus, and I can't exaggerate that, frankly, will occur if we get a slowdown and credit ratings get cut, folks. Pension funds, for example, can't hold below investment grade rated bonds. You have a ton in the lowest tranche of BBB. Those get downgraded. Pensions dump them. There's not the liquidity to absorb that debt. It is going to be scary. CEO confidence is currently at recession level lows. You can't find it this low outside of recession. Believe it or not, in August, more of them quit their jobs than in any month in history, and more have left their jobs year to date than they have this time during the Great Recession. Seems kind of weird. If things are going well, why would they lose their jobs? Well, maybe they realize that they boosted earnings per share artificially with these share buybacks and thus their bonuses as far as they can. And they believe that tougher earnings environment, i.e. a weaker economy, is on the horizon. Should CEO pessimism persist, it'll morph into job cuts. Once the consumer begins to fret over his or her job, folks, And I this is how I really want to say it. I think the ball game is over. The consumer has been absolutely the glue presently holding the economy together. The consumer gives up the ghost, and I think the economy gives up the ghost, and therefore the stock market does with it. Our proprietary macro index is scoring near its lowest level. It was a -8 this last week. Since the last recession, that's heightened recession risk. Unique and huge election year uncertainty to come. I don't think I need to expand on that. And then, ironically, should for whatever reason, surprisingly strong U.S. economic performance, or let's say a sudden lack of interest in U.S. debt, and bond yields begin to rise notably for an extended period, the presently bulging, dangerously low-quality corporate debt structure may begin to crack. A scenario which by itself and ironically could bring an abrupt and reversal in economic activity and thus catalyze the next bear market in equities. And I'm going to close by sharing with you an article that showed up ironically because I posted that last night on Bloomberg this morning. Any sign of deteriorating investment confidence in the U.S. bond market could raise the risk of a debt spiral. The U.S. may face increased vulnerability to foreign government holdings of debt. And they add, and I agree, rising debt servicing costs crowds out investment in productive boosting areas like infrastructure and research. It's to the point, in my view, where it is virtually going to be impossible for it to resolve itself without somewhat of an implosion. I mean, if the rates begin to rise, that's addressed right here. If the economy rolls over, credit ratings begin to get downgraded. That's the other scenario. That's where there's a huge unloading of that debt, gets forced onto the market when there's no liquidity for it. Rates spike. It's messy there as well. So right now, the powers that be obviously don't want to see that happen, and I think they do see that looming under the surface. So there's a situation, folks, where we, again, on a very short-term basis, you can't help but be bullish for the reasons that I mentioned. You get out beyond that, and perhaps that picture slowly but surely in a better economy gets resolved. But basically, for that to happen, we'd have to see some fiscal discipline, and that's addressed here as well. For a sustainable path, the deficit would need to be reduced by 1.8% of GDP in 2020 and 2.2% by 2025. In sharp contrast, folks, right now we're estimating more or less a 4.6% deficit, which is projected by the CBO, the Congressional Budget Office, over the coming decade. Hard to see in a fresh election cycle, of course, anything that would remotely resemble fiscal, responsibility. Again, to kind of sum it up, if the economy continues to wane and that begins to lead to lower profit margins, of course, layoffs because CEOs are so pessimistic, the layoffs would be probably just a trigger that would play hell with the markets. Or, again, using the example up in here, let's just say because of, our relationships internationally and so forth, or, the prospects for the U.S. economy, maybe foreigners just, begin to shun the dollar. Maybe there's less of a buying of U.S. government debt. We know that we've had some short-term funding issues in the overnight funding market that has got the Fed very excited. That has something to do with this new $60 billion a month of money printing that they're now doing. That just brings in another element. So they started printing money. Now the stock market is kind of trading on that. What if they get that overnight situation fixed and they say, okay, we don't need to do that anymore? Is the market going to see that as monetary tightening and then roll over in that regard? So again, folks, I'll say it for the umpteenth time. Can't help but being bullish on a short-term basis. I have no desire to play that theme right now. I want to see the next few months unfold. I want to see how the jobs numbers hold up against this pessimism among job makers, and just see how, of course, the China trade deal unfolds. I think Brexit will be a positive, and of course we turn over the calendar, and then we've got next year's election, and boy, the dynamics there. So. A lot to think about, a lot to consider. Right now, we're modeling different scenarios in terms of how we're going to handle this next year, stay protected, and try to eke out some gains at the same time. Our analysis is dynamic like the markets. It's ongoing, ever-changing. We are not wedded to any bullish or bearish thesis. We just want to have the right thesis from a longer-term perspective on behalf of the folks who entrust their long-term money with us. Thank you, as always, for watching and listening. Be back very soon. Bye-bye.